Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much discuss it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is my colleague, Mr. David Franson. David, thanks for being here.
Yes, happy to be here. Thank you.
So David's going to be reading your questions, and I'm going to do my best to answer them. You can send your questions in by either texting us to 913-363-1234. That's 913-363-1234. Or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, how would you plan differently if you had someone with $2 million in their IRA versus someone with $2 million in a brokerage account?
It's a tricky question.
Yeah, and for some, you might need to differentiate the two. What's an IRA? What's a brokerage account?
Yeah, so for starters, IRA, it's pre-tax. So you've made a bet that when you retire, taxes will be lower or you'll just have less income. It was an event to defer taxes to a later date. So that $2 million, you really don't have $2 million to work with. You've got...
Because you haven't paid the taxes yet.
You haven't paid the taxes. So if you were to take it out as a distribution, you're paying taxes. So is that 20%, 25%, 30% less than your brokerage account? A brokerage account, you've already paid the taxes, so it's invested in the market. Okay, it's not tax-free, as in if it grows and you sell it, you're going to pay capital gains tax. So you might pay 15% or so on the gains, not all of it, but on the gains. So you've got two completely different situations that you have to navigate. So let's just take them one at a time.
All right.
Sound good?
Yeah, let's do this.
Let's do the IRA. This is probably the more common one. People really focus on their 401k. They put a lot of money in their IRA and they've deferred their taxes. So the question really at hand is, how old are you? How much time do we have until Medicare starts at age 65? And then when do your RMDs start, which is 73, unless they change it again. Okay, RMDs are when the government starts to require you to take distributions from your account. They say, hey, we've let you deferred it, but we want to get paid and we don't wait until you die. So we're going to force you to do this. So the reason why those are two important bits is because a $2 million portfolio, in my mind, they've also got Social Security and maybe they have a pension. So if we're too aggressive on the income or we're too aggressive on IRA to Roth conversions, we may actually hit an issue at 65 for what's called IRMA. IRMA is a Medicare surcharge. So from 60 to 64 years old, we're going to treat retirement a little bit differently in how we're growing the IRA assets, how we're drawing down the IRA assets, and maybe we're a little bit more aggressive on the IRA to Roth conversions. And so I'll talk about kind of where the products and investments would be in that situation. But you need to understand the timeline of this. Then at 65 to 73, you might continue to draw down your income, okay, because you want to drain it. Not just drain it, but you want to spend it down while you're preserving the other assets like your IRA to Roth conversions. You would touch the Roth later on. I just said a lot. Are you with me so far?
Yeah, I think so. And so I don't know if everybody listening knows what a Roth is either.
A Roth, it grows tax-free. There's no capital gains. You can buy and sell and be active with it. And then when you take a distribution out, you don't pay taxes either.
So it's a retirement account, but you've already paid the taxes on it. And because it's a retirement account, it can grow
without capital gains taxes.
Yes.
Huge benefit.
Oh, yeah.
Huge benefit.
Yeah.
It is hard to get money into a Roth. They restrict that. They restrict all retirement accounts, but they restrict Roth almost a little bit more because it's so advantageous from a tax standpoint. And the government needs revenue, so they need taxes.
Right.
So my point being is you don't convert everything to Roth in a year. You want to slowly do it. And I believe that you should have a target effective tax rate, or basically how much you're paying in taxes during a more aggressive season of your life. So 60 to 64, maybe a more aggressive IRA to Roth conversion and income season when it comes to your tax planning. Then you lower it down once Medicare starts because you don't want to pay unnecessary surcharges if you can help it. And then you do that until 73. And then at 73, the ideal situation is you've baked in your RMD into the income. So let's say at 73 years old, you've got half your income coming from your RMD and the other half is coming from your Roth. Now you've got a very low tax situation. You've strategically planned it in such a way that you've balanced it. You didn't go all extreme on one or the other. What most people don't realize, that I have found at least, is that the zero tax bracket is actually not good for you. It's the lowest two tax brackets is where you want to be because you have the standard deduction for life.
Yeah.
As long as they don't get rid of the standard deduction, that's a tax advantage that you can incorporate in.
And the standard deduction, since what, 2017 or so?
It's been pretty high. And
it's been high.
It's expected to stay pretty
No.
high if Trump gets it through the tax plan.
Yeah.
So that's with the IRA one. Now, what assets would I include in here? Well, I would probably use or recommend our models, assuming that that's appropriate. We have different models for different people, but they're actively traded. But the active trading is not an issue because they're in retirement accounts. You're not dealing with capital gains. I have found when you just want to grow your money, absolute return models, fundamental models, I mean the momentum models, trend following models, they do rather well in up markets. They help preserve assets in the down. They're not protected, but they help in the down markets, and they give you a fighting chance, in my opinion, during flat markets. David, whether you knew this, well, you know this because we do this on the show, but many listeners might not realize that markets can go flat. The equities market can go flat for 10 years. That's suffocating for a retiree.
Right.
So we use models that also give people a fighting chance to make money in a flat market. Now, in contrast, if we were to have $2 million back to the pre-tax, I would fund the appropriate amount of the assets into our reservoir. So reservoir is anything that offers protection and growth. It lacks liquidity, but you can't have your cake and eat it too. And so the idea is a part of your portfolio is protected, has reasonable growth potential so that if the markets were to crash, you can take income from your reservoir and allow your other accounts time to recover. If the markets crash, you have your safety net with the reservoir. Why does the city have a reservoir of water? In case of drought.
Yeah.
They don't use it or have to use it all the time. It's just when they need it.
Right.
That's the point of having a part of your money in a portfolio. I don't understand why people still have a part of their money in a bond fund. Bond funds aren't safe. Bond funds can lose money. Debt's a continuing issue. We've seen that maybe the Fed doesn't control bond rates as much as we would normally assume. There's a divergence within market sentiment and how bond funds or bonds specifically are being received. So we need to understand these newer dynamics and adopt to a more modern portfolio.
Yeah.
Now, when you look at a non-qualified portfolio, I still would fund the reservoir because everyone needs to have some protected accounts for whenever the markets crash next, because the markets will crash. Over the next 30 years, I'd be willing to bet the markets crash at least once or twice because never in the history of markets have they ever done 30 years of pure growth. And you need income. You've got bills every year, so be ready for that. But in addition to that, I would probably move the growth to be more focused on things like special ETFs, so institutional ETFs that kind of were more active, but they didn't give you a bunch of capital gains issues. So as much as I love my models for growth, they're really better, in my opinion, for retirement accounts that don't deal with capital gains. Because if you actively trade non-qualified assets, brokerage accounts, the money you've already paid taxes on that's subject to capital gains, if you're actively trading on them, you can create all sorts of tax issues that bump into Medicare issues because you're getting taxed at the income rate, not at the capital gains, long-term capital gains rate. So there's nuance, there's complexity. If you have most of your assets in non-qualified brokerage accounts, that's going to change the recommendation if you have most of your assets in retirement accounts. So we need to stop oversimplifying, oh, well, I just bought a 60-40 portfolio. Okay, well, why? Why did you put that there? What's in there? What's not in there? I hate, personally, dividends being reinvested in a non-qualified portfolio because the dividend that's being reinvested, that's really where your growth is coming from, and you're getting taxed on the growth every time it goes. I mean, It's an issue. There's all these little issues here that really, and hopefully I'm doing a good job illustrating this, but when you have more assets in non-qualified brokerage accounts, your plan is going to be different than if you have it mostly in retirement accounts.
Mm-hmm.
That's why we say, let's put the plan together first. Can you afford to retire? Does it look okay? Then let's explore efficiencies. So where do you put non-qualified money in something that's not going to create a tax issue? What's available? What financial investments, instruments, products are available to help you do that? So you're not creating issues. If you have retirement money, what's available that makes it efficient for growth and protection and all the different things that you would want your money to do for you? Is this making sense, David?
It is, yeah. There's so much sort of
it's a
nuance,
complicated question.
Right? Yeah.
We could spend hours on this.
Yeah.
I mean, I'm answering questions as best I can, slightly shooting from the hip here. It would be fun. Maybe we'd do a case study at some point to break down what both would look like, just so people have more context with it.
Yeah.
And this is like a non-qualified portfolio. Maybe we include more REITs. Anyway, I digress here, but there's a lot that could be done. The strategies would be fundamentally different based on my interpretation of the differences between the two, and then how you get your money out when markets are up versus when markets are down. Very different situations. It might not seem like it's different. Oh, you saved $2 million. Taxes. Everything is affected by taxes. Mm-hmm. So your tax situation is going to affect the recommendations. And unless you can speak in a detailed manner about taxes, you might miss a few potential efficiencies. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles, or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.